Good morning, good morning, good morning. How's everybody this morning? All right, we're going to jump right in just a few seconds, but I want to talk to you about what we talked about on Wednesday. This is just a continuation. This is part 2 of the 2-part series, how to choose the best mortgage terms. If you are in the midst of choosing a mortgage, or getting a mortgage, or a refinance, all right, go ahead and put a number 1 in the chat. Put a number 1 in the chat if you're thinking about getting a mortgage, if you are thinking about refinancing, because you see, that's just another mortgage, or maybe a HELOC, a line of credit. That's a second mortgage. So if you're thinking about that, go ahead and put a number 1 in the chat, so that and we're going to cover some of that. If you have a question, go ahead and put a question. If you already have a mortgage, okay, if you already have a mortgage, but you're not in your forever home. Okay, you have a mortgage now, but you're not in your forever home. So there is an opportunity to maybe even refinance or get a new mortgage somewhere down the line, because now you're going to be moving into something closer to your forever home. Put a number 2 in the chat. So if you're thinking about getting your first mortgage, put a number 1. If you already have have a mortgage and you're thinking about maybe getting a refinance, or you're going to move on to another house, put a number 2. All right. So go ahead and put that in the chat. If you have a question, get ready to come up to the stage. I want to say good morning to Christina. She's been here before. Good morning. We got Israel in here, Rochelle, Queen, Dami, Vanessa, Tanya, Delvin, and Rita right now. Go ahead and put it in the chat. Say good morning and tell us where you're from. Good morning and tell us where you're from. I'm right here in Huntsville, Alabama. All right. And my name is Don Daniel. I'm going to put let's see, Huntsville, Alabama. That's where I'm from. That's where I'm living now. And we're going to send that. Boom. All right. Rita says number 2. So she's got a mortgage, but she's thinking about getting something else or doing something else with that money. We're going to show you what you never knew before. Some of the things we went over on Wednesday. 15-year mortgages versus 30-year mortgages. We talked about that. Never get a 15, always get a 30. All right. We talked about prepayment penalties. We talked about having a fixed rate mortgage versus a mortgage that will adjust, an adjustable rate mortgage. Christina from Atlanta, how are you doing? All right. Down payment deceptions. Never put a large down payment on a mortgage. So we talked about some of those things. So we're going to get into, we're going to talk about, we talked about refining to when you refi and roll in high interest debt. We talked about that as well. A consolidation loan, using your mortgage to consolidate. Well, let's talk about refinancing altogether. All right. Is it a good idea? Is it a bad idea? The real answer is I don't know. What you want to find out is it going to get you closer to your goal? What is your goal, right? When you want to refinance? I can tell you this. I can tell you this much. Never, ever, 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 ever refinance just to get a lower interest rate. We're going to start there this morning. Never refinance just to get a lower interest rate. You want to put yourself in a better financial position. And the financial position you want to think about, folks, is right now, my mortgage costs me X amount of dollars for the time that I'm going to be in it. X amount of dollars. So if you want to put yourself in a better financial position, you want your mortgage to cost you less over time. How can I get my money cheaper? So if by refinancing, you're actually setting yourself up to pay less interest over time, then do it. But most times, folks, refinancing does not do that. How do I know? Well, listen to this. If by refinancing you're saving money, who would have to be losing money? If by refinancing you're saving money, who would have to be losing money? And folks, refinancing is a huge business. It's a business model, and it's not set up so the banks can lose money. It's set up so they can make money. And we're going to show you just a couple of ways of that in just a few minutes. But first of all, folks, we need to share with you, all right, the P.I.L.L method and what it means, what it stands for. The P.I.L.L method. Prepayment of principal, isolating the principal amount, leverage, and liquidity. By understanding these 4 basic principles, you can understand loans from a very basic level. All right. You're getting your education here about how loans really work and how you can save thousands upon thousands of dollars you don't need to spend. And what I mean is all of your loans cost you money to manage. So what we're talking about here is how to lower your costs in the dirt. I mean, you want to pay the least amount of interest that's mathematically possible for you. And that's what we teach here. You want to get the basics here. All right. And we have also the best technology in the world to help you to accomplish that purpose. So we have the best technology and we have the best financial education, bar none. No one is doing what the P.I.L.L method is doing in helping people to accomplish their financial goals. Someone who recognized that his name is Dr. Eric Thomas, E.T., the hip hop preacher. And he realized that. And by understanding that, he is helping his wife feel better about their financial situation. Let's hear from him, and then we'll talk about the book later. Dr. Eric Thomas, come on.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
You heard him, folks. He is the #1 motivational speaker on the planet right now. And he uses the P.I.L.L method to pay off his mortgage so that his wife could have less stress. That is amazing. Now, I also had the privilege. Now, he writes books, okay? And he's got a brand new book out that is on multiple bestseller lists right now. But in May, I had him come in to speak for our conference. And I was able to sign my book and put it in his hand. And we have pictures about that. So, folks, here's the book, The P.I.L.L Method, A Better Way to Eliminate Debt. If you want the basic information on how to read an amortization schedule and to learn what we should have learned in grade school about how loans really work, okay, then this is the book. It is the only book out of 33 million titles on Amazon that talks about how to read an amortization schedule and how to defeat it, how to get the most out of it so that you don't have to pay a whole lot of extra money. And folks, that extra money you're paying in interest, you can't also invest that money. So this interest is robbing you of generational wealth that you should be building even now through compound interest. But you can't earn compound interest on money that you spend. The average client saves $100,000 to $150,000 in interest they don't have to pay. Can you imagine if that 150,000 was put so they can start putting that away in small increments so that they can start earning compound interest on this now, and 22 years later, 20 years later, what that money would mean to them? That's money they did not have to spend on interest. Oh my gosh. So get the book, folks. Get the book today. And because it's so close to Christmas, you will be able to order extra copies and give them away as gifts. I'm telling you, if you do that, this will be the best gift you will ever give someone: the ability to understand lending the way it should have been taught in the beginning, so that the banks won't keep siphoning off your wealth. Now, I'm not anti-bank, but I am pro-education. You need to know this. Good morning, Lady Miss. Good morning, Lena. How are you this morning? Listen, folks. Lena, I see you got your balloon there. Happy Clubhouse anniversary to you. Let me check out and see here how long you've been. Okay. Oh, 1 year. 1 year on Clubhouse. All right. Fantastic. Good to have you in here. Folks, we're going to be putting some things on the screen. And if you want to see what we're talking about, go to Facebook, YouTube, Twitter, LinkedIn, search P.I.L.L method on a secondary device like your laptop or your tablet computer, and you'll be able to see what I'm getting ready to put on the screen right now. I said we're going to talk about first, we're going to talk about down payment deception from a different perspective. We talked about down payments in the form, not down payments, refinancing. All right. People who refinance to cash out and pay off high interest debt. I showed you that on Wednesday, by doing that, people who are like rolling in their 28 and 29% credit cards and their car loans and their student loans into their mortgage are actually trading a 20 to 30% interest rate for 350 to a 300% interest rate by rolling it in the mortgage. You want to see Wednesday's show that will help you to prepare this. So let's go ahead. Let me pull up some things on the screen, and I've got to see where this opens up so I can give our producer Kurt Nugent which screen to put this on. And I got to see here, which screen is it going to go on today? All right, it's going to go on screen 3. And so that's the one I need to share. So let's get out of here and put this up, get that out of here. All right, move this over, and move this over. All right, we'll keep our thing on the screen there. All right, here we go. And we're going to share the screen. All right, and there we go. Okay, share screen. And we want, there we go. All right, folks, we're getting ready to get started here. And I'm going to put on, let me see here. We need to move this over to this screen. I'm using 3 screens today, folks. That's why I love Kirk being here, because as I'm watching like 4 different screens, he's helping us to make sure you're able to see everything. All right. So let's go ahead and put that on. And I need to get to down payment deception. So let me get over to that part of our slideshow and we'll get it ready. All right. No, I was Refi fantasy. All right. Let's put that up. That's what we're talking about. Refi Fantasy. We are all set to go. If you have a question or comment during this session, go ahead and raise your hand. And I'm going to talk about right now one of the things that we need to be careful of when we refinance. And here is the first thing. If I have, I've got a $200,000 loan at 6%. The bank is now offering me 3%. All right. And they're going to roll in the closing costs into my mortgage. Should I take it? The first answer is I don't know. All right. But let's take a look at how this thing shakes out. Here's what you want to know, and write it down. Just by getting a lower interest rate does not automatically mean you're in a better position. Because for some, even for most people, having that higher interest rate actually has you in a better position to pay the loan off faster and cheaper if you know what to do. And we're teaching what to do. So let's go over some of the basics here, and then I'll show you some other things about having a higher interest rate versus a lower interest rate when it comes to refinancing. Okay, so here is the $200,000 mortgage at 6% over 30 years. The monthly payment is $1199.10. Now, here's the first thing that you need to understand. People generally refinance after 5 to 7 years. 5 to 7 years. And I think it should be a requirement for people to see how much interest they've paid in those 5 to 7 years. So let's take a look at this loan. All right, let's take a look at this loan. And if you're looking at cumulative principal and cumulative interest, that's column 3 and column 4 on your screen, you'll see in 11 months, all right, that this person has paid $10,944.42 in interest on this loan already in just 11 months. In 12, look at this, in 12 months, look at that, 11,933.19. Wow, that is a lot of money. 11 grand, almost $12,000 in just 1 year in interest alone. In 2 years, folks, that's $23,714.90. That's just in 2 years. That's just the interest paid. And guess how much money has gone to pay down the mortgage in that amount of time? Only $5,063.50. That means that this person has paid out over $28,000 just to get $5,000 paid down on their loan. That's it. That is a whole lot of money. Now, here's what we're looking. Here's 7 years in. 7 years in. Oh my. $80,000 in interest already paid and only paying the loan down by $20,000. Listen, folks, this is a $200,000 loan. And they've already paid out $100,000 in the first 7 years. On a $200,000 loan, they've already paid $100,000 and they're only in year 7. What is wrong with this system? Does anybody else see anything wrong with this system? Wow. Listen, that can't be good. That cannot be good. So here's what we're looking at. Do we want to go ahead and try to refinance when we've already paid $80,000 in interest and we didn't even realize it? Watch what happens here. Watch what happens. So at this point, they owe $179,278.87 on this mortgage after 7 years. And now they're going to be able to get a 3% mortgage. Now, I put 5% closing fees on this. Yeah, Well, that's really conservative. To close on a mortgage these days is anywhere between $8,000 and $10,000 on average, and I have seen it as high as $17,000 to refinance. So, and they just roll it into the loan. They just rolled it into the mortgage. Now, here's our new monthly payment. All right, our new monthly payment is this. So once we add the 5,000 in, now we have 184,278.87 at 3% for 30 years. Yes, we were 7 years in, and we got a new 30-year mortgage. Lesson number one. Are you ready? Are you ready to write something down? Lesson number one is the major factor in lowering your payment is not the lower interest rate. The most powerful part of lowering your payment is taking what you owe and dividing it by a new 360 payments. That's the major factor in lowering your payment, not the new interest rate, and no one points that out. In fact, what you have here, folks, is a situation where you have a 30-year mortgage. 7 years in, you refinance, and now you have a 37-year mortgage. Isn't that true? Anybody ever think about it that way? And do you know that Americans, watch this now, Americans don't have 30-year mortgages. You know what they really have? Most Americans have a string of 5 to 7 year mortgages until they die because they keep refinancing for whatever reason. Not 30-year, a string of 5 to 7 year mortgages. So if I get this new interest rate, all right, and then for whatever reason I refinance 7 years from here, now I have a 42-year mortgage. And every time I refinance, I keep adding it on. I keep adding it on. Folks, that's why 9 out of 10 people will never pay off a mortgage because of that. That's another thing that happens when we refinance. But watch, let's just look at the numbers, okay? So now you've seen this part. Let's take a look at the numbers here. And if you're new to the room and you want to see what we have here, go to YouTube, Twitter, Facebook, or LinkedIn, search P.I.L.L method, and you can see the live that we have up on the screen right now. So you can see what we're talking about. So now we have a new principal amount, $184,000. We have a new payment of $776.93 because our old payment was $1,199.10. So we got a new lower payment. All right. But look at this, a new 30-year mortgage. Okay. But our annual interest rate is 3%. That's got to be better. And look here, we're still going to pay another $95,000 in interest even on this loan. And $95,000, $95,415.93 is what percentage of the $184,000 we're borrowing? It's still 51%. 51% of what we borrow, the bank wants in interest, even at 3%. So folks, here's point number 2. The interest rate you're quoted is not the interest rate you end up paying. You're quoted 3%, but you're going to pay back 51% of what you borrowed. $95,000 is, listen, can I have people put 51 in the chat right now. Put 51 in the chat right now, because that's what this is. It's not 3%, it's 51%. Put 51 in. If you're listening to me, if this means something to you, put 51% in the chat right now, because we have been lied to. Now, here's what I mean by lied to. All the information for you to understand this is in your mortgage documents. But you have been allowed to believe that the 3% was really 3%. You were allowed to believe that. No one stopped and said, you realize that this 3% really means 51%. Has anybody at the closing table ever said, stop? The 3% mortgage you're getting ready to sign really means 51%. Or the 4% mortgage you're getting ready to sign really means 71%. Or the 6% mortgage you've already signed really means you're going to pay back 93%. And if you have a 7% mortgage, take that back. 5% mortgage is 93%. 6% mortgage, 115.838%. 115. You're going to pay back more in interest than you borrowed in principal. So folks, that is, I see the 51s showing up. I see the 51s. You need to understand this. Everybody watching this needs to know this. Now watch. We're going to continue here. My old payment, $11.99.10. I'm sharing with you how this is sold. Okay, Lady Miz put 51%. Oh my goodness. Thank you, Lady Miz. Okay. Anybody who wants to talk about it, raise your hand. Let's bring you up to the stage right away so you can ask your question or make your comment. The old payment, $11.99.10. Old payment, $11.99.10. We have 9 people watching us online here. Old payment is $11.99.10. New payment is $776.93. I'm saving $422.17 a month. That is how it's sold. They just sold you a new 30-year mortgage just so you can save $422.17 a month. I need to know from everybody, is getting a brand new 30-year mortgage, is it worth it just to pay $422.17 less a month when you were easily paying the $11.99.10? That wasn't a problem for you, but you got an offer to get a 3% mortgage, and somebody sold you that was a good idea to pay $422 less, but it's going to cost you what? A brand new 30-year mortgage to get that. If you believe this is a good deal, okay? If you do not believe this is a good deal, go ahead and put a no in the chat. Put a no in the chat right now if this is not a good deal. If you believe it is a good deal, put a yes. Listen, I'll get a brand new 30-year mortgage after I've been in for 7 years just to pay $422 less. Brenda Jackson says no. Lady Miz says, I'm about to make a principal payment early. Ooh, Lady Miz, you're getting ready to save some interest. I had a lady call me. All right, here's a story for you. I had a lady reach out to us who bought my book. She's in the next town over. She didn't realize she's in Decatur. I'm in Huntsville. She didn't realize when she bought my book, she didn't realize I lived right in the next town over. So she sent us an email. So she's learning how to prepay and all of this. And she calls up her bank. Oh my goodness. She talks to 6 people there and talked to them about what she's learned from my book. She says, I talked to 6 people there and none of them knew what I was talking about. She was trying to figure out what was the best time to pay her mortgage to save her interest. When was the best time to put an extra principal payment on to save her interest? They said, not only did they not know the day, they didn't even know how you could save interest by doing that and to try to figure it out. They had no idea. And she talked to 6 people there at her mortgage company. So she writes us an email. How do you do that? I said, well, the only way to do that is to do the math and figure out with your particular financial budget and footprint, what is the right day for you in this month? But it may change the next month. It is not the same every time. Okay. When you're putting money on debt, you don't do it every month anyway. You don't pay extra every month. You don't do a principal prepayment every month, only at strategic times during the year. And when you do that, you can optimize your interest savings, meaning here's how you save the most amount of interest per dollar applied, letting the computer figure it out. She says, oh, no wonder they didn't know. And I say it in my book. Here's who does not know what you're learning this information from my book. Here is a short list of people that don't know what's going on in my book. Real estate agents, loan officers, CPAs and accountants, financial planners, people that should understand money, insurance agents, people who should understand money from this level, helping you to get out of debt. They have no idea how the loans actually work because they were never taught. So if the financial professionals have never been taught, how can they teach us who are not financial professionals? Now, how do I know what I know? All right, write this down. I am autistic. When I look at things, when I look at an amortization schedule, I see pictures and patterns very few other people can see. So somebody didn't sit down and teach this to me. So for everybody out there who is thinking about wanting to do business with us, to get a savings and earnings report, don't think that I'm sharing with you something that I've learned and is being taught elsewhere. And now you're going to try. And now the tendency is people call me and ask me, Don, what do you charge? How much do you charge? I said, for what? What am I doing for you? They said, well, basically, what do you charge? I said, I don't know what I charge because I don't know what you need. And besides, you want to know, when you're asking how much somebody charges, you want to know what you're going to get for that money that you've paid. And before you sit down and talk with us, you have no idea what we can do for you based on the current information you have about finances. You've got to get rid of all of that and understand that we're giving you something completely new. And then when you see what your benefits are going to be, then you can then understand our charges. Oh my goodness. It's a brand new day, folks. It's a brand new day. So here's what we've got. $422.17 in savings. Now, remember I told you we have $5,000 that we prepay, that we have in the closing costs. Let's start paying back that $5,000 in closing fees. In 4 months on this brand new mortgage, we've only, I need you to look at column 3 and column 4. The numbers are in red. If you're new to the room, go to, just go to go to Facebook or YouTube, Twitter, or LinkedIn, and search P.I.L.L method, and you can see what we're talking about. All right. So in column 3 and 4, we have paid back on the $5,000 in closing fees, only $1,200. Look how much interest they've received on a $1,200 loan, over $1,800. In 7 months, we've paid it down by $2,230. Folks, we're just paying back the fee just to get back to, oh my goodness, just to get back to the original amount of the loan before we refinanced. We added on $5,000 for this privilege. In 10 months, we've only paid back $3,000 of the fee, and already we're at $4,500 in interest. In 12 months, that's in black, it's not in red, but in 12 months, we've only paid back $3,800 of the fee with a $5,475 interest tag on that. Oh my goodness. Lady Miz wants to come to the stage. So I said something that has her going. Lady Miz, how are you doing this morning?
I'm doing great. How are you?
Excellent. Thank you so very much. What's got you excited this morning?
Everything.
What do you want to talk to? What do you want to talk to us about?
Well, I actually had a question. I'm not sure if you will be able to answer it, but I want to tell you what I'm trying to do. I want to build my real estate portfolio, right?
Yes.
And I already have two mortgages. Hopefully today I'll get the time to fill out the paperwork so I could set up a meeting with you.
Yes.
Um, so I already have two mortgages. Now I do have the money to pay for something else, but I know getting another mortgage might be an issue when they use the debt to income ratio. So my question to you,
Mm-hmm.
when we talk about interest and things like that, two things, if if you know about it. One, is it smart to do an interest only loan? And two, should a person use a no doc loan? Are you familiar with either one of those? And if so, would you be able to
I
tell me if they make sense?
absolutely love both.
Oh, you do? Why? Can you explain to me why?
I love both of them. Okay. Remember, listen, if you've been in my room before, you know that if you control the principal payment, you control the loan. Have you ever heard me say that?
Yes.
Okay. If you have an interest only loan, that means the principal payment is controlled by you. You pay principal whenever you want to and the amount that you want to. There's no one dictating to you how much that is. Okay. There's somebody that's trying to sell something in our on our online comments. So let's get rid of them. All right. So,
Oh boy.
all right. So there you go. They're gone. Listen, that's why you have to have a great engineer. I've been telling you, Kurt Nugent keeps us on the air live and going strong. But here's what I'm saying. So if you have a interest only payment, correct?
Yes.
Your payment is determined by your interest payment is determined by how much you owe. Isn't that correct?
Correct. Mm-hmm.
Well, what if you give the bank, give me a number. What if you want to pay some money on principal, right? Because you're not required to. You're only required just to pay the interest. But what if you want to put money on principal because you can? Having a interest only loan does not mean you cannot pay principal. Did you know that?
Yes, I knew that, but I always wanted to stay away from those because they seem
Why?
so scary to me.
Wh-
Like, oh, you're going to be paying interest forever. But I guess it makes sense. Now it's like, you don't have to do it their way.
You don't have to do it their way. It sounds
Right.
scary, doesn't it?
It does.
Listen, everything sounds scary until you know what to do. Can I ask you something, Lady Miss?
Sure.
How many young artists do you see that come up to you and ask about getting into the business and they're scared to move forward? How many?
It's not that they're scared. They just don't know what to do in the right way to do it.
Oh, so do you have the same trepidation as they do?
No.
Why is that?
Well, I educated myself. I took the time to learn the business and
Yes.
to educate myself on it. So now, I'm more aware I can make better choices and better decisions.
There you go. And that's what we're doing here. Some people think that the major portion of what we do is our technology. But the technology is in and of itself no good without the advanced education on understanding how loans really work. So you're getting that education. The education that you're giving a young artist getting into the music business is information that you've gleaned over the years, and you don't have the same trepidation as they do. And Lady Miz, let me tell you something. Getting this education is going to be the best thing you've ever done. So let's take a look at it. So now, give me a number that you could put down as a principal payment on a interest only loan.
$1,000.
$1,000. So whatever you owe. So if it's a $200,000 loan and you put $1,000 on, okay, your interest payment is based on a $200,000 loan.
Right.
But if you give them $1,000, now you have a $199,000 loan.
Yes.
Can they charge you the same amount of interest as your payment now?
No, they can't.
So you are in ultimate control of this loan. Not only can you pay principal whenever you want and get the benefits in the way that you need to get them, you can even control your payment.
I love that.
Doesn't that make sense to you once you know?
Yes, it does. Because like I said, I've always been so afraid to do interest only because I didn't understand the technique and the method behind it. So now I know I don't need to be afraid anymore. Now, what about that no-doc loan?
Come on, the no-doc loan. Now, here's what we're talking about, a no-doc loan. Now, basically, it depends on the bank. But on a no-doc loan, they're going to take whatever you tell them as evidence. Okay? They're going to take whatever you give them as evidence. Like, how much do you make? All right. And then you tell them, I make X amount of dollars. And they may not ask you for documentation to prove that.
Right.
Okay. Now, here's what you need to do. If you can get a no-doc loan and they're asking you good questions, okay, you don't want to put yourself in a position just because it's no-doc. You don't want to put yourself in a position that's going to hurt you financially down the road.
Right.
Okay. You just listen, having a no-doc loan just kind of speeds things up. And we got Norman in here, and he's a real estate agent. So let's see if we can invite him up to speak, and get him up here. So listen, we are talking about, how do we understand this whole idea of no-doc depending on the bank that we're dealing with. No-doc does not necessarily mean bad, but it can be abused by getting more than you're able to handle. That's the only thing you have to worry about. But being one of our clients, the major portion of what we provide is education and and consulting on these issues so that you can stay out of trouble financially.
Okay.
So you have a built-in consultant to ask these kinds of questions so we can run the numbers.
Wow. Okay. I got to definitely get on the move on it then. I can't be playing around. Like I said, I'm getting ready for work. Sometimes it be taking up my time, but I'm finding time today to fill that out because I was looking at a property over here.
Yes.
Another property that I wanted to purchase. And I want to move. Well, I'm not trying to move fast, but I do want to move quick enough to go over everything with you and sign up before I make that decision. I don't want to make the wrong decision.
Ah, good. So Armand has something online. He's saying interest only loan as the same as a first tier home equity line of, it works the same way. Armand, if you have a home equity line of credit in first position, that means the only mortgage you have is your home equity line of credit. And if you have the interest only option, every time you pay principal, then it lowers your monthly payment. Your minimum monthly payment every time you put money on principal. But guess what, Armin? If you out of your budget, if you could know the exact amount of money that you would need to leave in your line of credit to maximize your interest savings per dollar applied. There's benefit in that. Norman, how are you this morning?
Don, good morning. It's been a while. I'm glad to be back and be able to support. How are you?
Listen, man, I'm doing great. I'm doing great. I'm doing great. What can you tell us? Can you tell us, being a real estate agent, can you tell us about no doc loans? What is your experience?
I've not had any experience with no doc loans. Can you
Okay.
maybe express that to me a little more?
All right. Well, we've talked about having you have to have on a regular mortgage, you have to have all this documentation and proof of how much money you have in the bank, blah blah blah, how much money you make, and then on some of these loans, especially in commercial loans, if the loan makes money, if the deal makes money, if the bank can lower their exposure by making sure that if you default, they can sell the property, some of these commercial banks will not require you to have the same type of documentation as other banks. They'll take your word for it.
Wow.
Yeah.
Yeah, that's you definitely want to have some expert eyes on the deal there, because I do know from just my experience on the commercial side, those covenants are very important. And you don't want to break contract or break the covenants that they have in place,
Mm-hmm.
because like you said, that gives them the ability to either collect the funds on the loan early, that's
Mm-hmm.
called calling the loan,
Mm-hmm.
or to even take control of the real estate.
Yeah. Meaning, give it back because you didn't pay.
Exactly.
And they love to do that. And some people even call that lending to own. Lending to own. What does that mean? I'm going to lend you money on a property, and I'm really secretly wishing you would default because I'm going to be in a much better financial position if you do. Lending to own. Remember that, folks. Remember that. Lady Miz, are you complete for now?
Yes, I did have one statement. I just wanted to tell you, I had interviewed someone who do know doc loans,
Mm-hmm.
and one of the things that he told me was it it doesn't really matter what like it your debts and things. It
Right.
only matters when they can make money. If it looks like the home or the business is going to be able to make money. So someone looking to do a single family home that they're going to live in
Mm-hmm.
is not something that a no doc loan would be good for.
There you
It
go.
has to be something where that they know, hey, we don't care what you got going on. If we know that we're going to make some money off this deal, then we're in.
Exactly. Exactly. So that means that you're getting into the property under that's under market value, plus the amount of money that you have to put as a down payment on a commercial deal improves the bank's position here, and they will lend you money that even if you default, they can sell it and make money.
Yep.
Okay,
There you go.
that's
Right.
that's what it means for. I listen. I would not be afraid of a no doc loan.
Okay.
All right.
Thank you so much.
But
Yes.
we're going to be able to actually give you advice there so that you can know. How would you like to be able to know, what is this going to mean for me 10 years from now? We
I
can
would love.
we can project that so that you can make good decisions based on what's going to be happening in the future.
All right.
Okay?
Yes, thank you so much.
You're welcome so much. Is there anybody else here that's raised their hands wants to come to the stage? Okay, so folks, here we are. We're in a situation where we've refinanced, paid $5,000, all right, for the refinance. We've already paid $80,000 in interest in the first 7 years on this loan, and now we're refinancing, okay? So in 12 months, we're just paying back the $5,000 fee. In 12 months, we've already paid $5,475.74, just trying to pay back the $5,000. Let's go to the next slide. All right, so here's we have it, and in line 13, okay, starting out in the next year, starting out the new year, okay, on this loan, we've only paid it down by $4,173, but it's cost us almost $6,000 in interest. On line 16, Line 16, that means we've been in this loan for 16 months and we finally paid back the $5,000 we borrowed in closing costs. And it cost us $7,275.16 to borrow that $5,000. Folks, let me ask you something. If your bank or credit union sent you a notice in the mail that says, we want to lend you $5,000 for 16 months. And all you have to do is pay us $7,275 in interest on that loan in 16 months. Would you sign up for this loan? Tell me, put it in the chat, yes or no. Would you sign up for this deal, borrowing $5,155.72 from your bank or credit union, and then it says 16 months later, you will have paid us $7,275.16 as you've paid back this $5,000. Anybody would accept that loan? LaShonda said, nope, not me. No. Brenda Jackson said, nope, not me. Come on, folks. This is what's going on. This is what's not being shared with you. All right. So let me ask you another question. If you borrowed $1 from me and I say, pay me $2 back. Okay. Give me $1, give me my $1 back and $1 in interest. What interest rate am I asking for? Put it in the chat. What interest rate is that? When you pay $1 interest on $1 loan, what interest rate is that? Anybody know? Go ahead and put it in the chat, put it in the comments. Lady Miss says 100%. Norman says 100%. RC says 100%. Jonathan Jones, listen, they're saying 100% interest. So folks, if you borrow $5,000 and your mortgage says 3%, but if you borrow $5,000 and you pay back $5,000 in interest, what interest rate is that really, even if it's in your 3% loan? What interest rate is that, folks? Come on. $5,000 you borrow, pay back your $5,000 plus another $5,000. Whoo, look at that. Look at that. Look at that. What is it? What is it? That's still 100% all day long, folks. It's still, well, actually, it's a little over 100%. It's like this is like 120%. 120% interest on a $5,000 loan. This is one of the reasons why banks they thrive on refinancing. So whatever money they lend you for the refinance times the 1 million, 2 million, 10 million customers that they have, they can lend you anywhere between $5,000 and $17,000 to refinance, and they're going to make anywhere from 120 to 300% interest on that loan, and you don't even realize they're doing it. That's one of the reasons why they do refinances. It is a huge moneymaker. Somebody got something to say?
Yes, and I know you're talking about mortgages, I believe, but this is why you also get those letters in the mail about getting a new car, trade up. So if there's a new, 2003 model of your car, they want you to come in and, hey, we'll, finance, give you a lower interest rate, sure, but of course the interest is what they're concerned with collecting.
Exactly. And when you do that, folks, most of you have negative equity in your car. Used car prices have dropped in this year by 15%, over 15%. So you used to be able to make money on your used car, but now it's getting to the point where you're not making money anymore. So most people who trade up go in and take their negative equity and make it part of the new loan. That means you owe more on the car than the car is worth. So they're going to take, that's called negative equity. You put it into the next car, and they use that and the banks use that to make money. So you're taking your new car plus part of the old car, putting it on the same loan so that the bank can make more money in interest from you. Folks, this is why we exist, to tell you the truth about these loans so you're not paying all of that interest, because the more interest you pay, that's money you can't also invest for you and your family. Oh my goodness. Any other questions about this? All right, because we're getting ready to move on. I just needed to show you just a couple of things about refinancing. So on my list here, what are we talking about here? We're talking about consolidation. All right, let's talk about outside of that. Let's talk about paying off your credit cards every month. What does that have to do? What does that have to do with mortgages? Let's go ahead and put the book back on the screen, and we're going to talk about interest rates, interest cost versus interest rate. Okay, in my book where we talk about interest cost versus interest rate, let's talk about what we're doing with by paying off our credit cards every month, how that makes us feel. It makes us feel great because we're paying off those credit cards. I'm not saying that we shouldn't. I'm just saying that it could be that we're making a financial mistake doing it the way that we're doing it. All right? So let's take a look at what's going on here. So in my book that you can get on Amazon, go to Amazon, you can get this book and give it out as Christmas gifts this year. Get it for yourself and get it for others. This is the kind of thing that you learn from talking to us. Do you know how many people I talked to over the years that have told me, Don, I never, ever pay credit card interest? Does anybody want to see what the problem is with only focusing on paying off the credit cards every month? I have somebody here that says, what is this? Oh, Vernell, the Uber driver, says, hi, I saw you briefly and turn my head to the other side. Now again live, where I find your book. This is very interesting. Okay, that's what we're talking about, Vernell, the Uber driver. Okay, where you can find the book is on Amazon. The P.I.L.L method, a better way to eliminate debt. All right. So when we're talking about just this subject alone, how could that hurt your mortgage if you are looking at paying off your credit cards? All right. And why do we do that? Does anybody want to come to the stage and help me talk about this right now about credit cards? Because I'm getting ready to put on my screen here an amortization schedule. And we're going to go over that. Paying off the credit cards in a way. Okay. So let's go ahead and put Brett Whistle on the screen. If you want to see this, go to LinkedIn, YouTube, Facebook, Twitter, and search P.I.L.L method, and you'll be able to see this live. All right. So let's take a look at now. I need who wants to share with me the highest interest rate you've ever seen on a credit card? I need you to put that in the chat for me because I need people to kind of help me out here. What is the highest interest rate you've ever seen on a credit card? Somebody tell me. Go ahead, put it in the chat. Put it online. LaShondra says 26%. Anybody else? She says, I've seen 26%. Anybody seen anything higher than 26%? Okay. All right. Since no one has put anything else in higher, we're going to use LaShondra's. We're going to use her example of 26%. So I'm going to put in let's put in $10,000. Okay. $10,000. And I'm going to teach you how the bank looks at that's 100,000. We need to delete that. $10,000, and we're going to put it in as 26%. 26%. all credit cards are amortized not over 360 months, but 240 months. 240 months. Okay? So let's go ahead and calculate that. And let's see here. We're going to delete. No, we got to add another zero. $10,000 at 26%. 240 months. All right, I need you to show you the interest cost on this loan. Okay, on the very first payment that you would owe interest, your interest only payment, that is your interest cost on this loan, $216. $216. What does that mean? $216. Okay. If I pay off the $10,000 in 1 month, okay, what is the most the bank can charge me if I borrow $10,000? What is the most they can charge me in 1 month? Okay. Oh, something happened to my studio lights. Hold on. Oh, there we go. All right, had to adjust them. All right. So, what is it that how much can they charge me? Okay, what is the most they can charge me? Anybody put it in the chat. What is the most they can charge me? Listen, Norman, thank you much for being here. All right. What is the most they can charge me based on what you see here? It's $216.67. That's the most they can charge me in 1 month. So, folks, by paying off the entire $10,000, what is the most interest I can save? By paying off the entire $10,000 at one time, what is the most interest I can save by paying it off? Folks, it's the same $216.67. So let's go ahead and put on our $200,000 mortgage that we were using before. Let's put that on. $200,000 at 6%. 200,000 at 6%. Boom. All right. 199.10. All right. 1199.10 is our payment. So now I could take the $10,000. Listen, I'm just saying you need to understand what's going on. We can't look at interest rate. We need to look at interest cost. So I could take the $10,000, pay it all off at one time on this loan, on the credit card, and save myself the $216, $216.67 in interest. Or if I wanted to, I could pay Visa or MasterCard the interest that they're looking for, not pay off the credit card that month. Take the $10,000 I could pay off the credit card and apply it to this mortgage. Look what happens. I need you to take a look at cumulative principal. I feel good about paying off my credit cards every month. But what could I do with that $10,000 if I put it on this mortgage? It knocks off 45 payments. 45 payments. 40. It knocks off 45 payments and saves $42,000 in interest, not $216. Folks, can you see that we need to take a more strategic approach to our debt? I'm not saying don't pay off the credit cards. What I am saying is, should we take a more strategic approach to our debt if we're taking a look just at interest rate when we should be looking at interest cost? So here's my question. If this is my situation, by paying the credit cards off every month and ignoring the mortgage, am I setting myself up to be in debt longer? I need to see your answers. Okay? A lady miss said, I'm sick. I just paid off $8,000 in credit cards last month. She's shaking her head. She says, I could have put that towards the mortgage. See, folks, when you work with the P.I.L.L method, we're taking, this is the knowledge that we have been taught, is to pay off those credit cards. But we can use that to leverage. Listen, I would pay $216 every day of the week if it would save me $42,000. Listen, folks, are you hearing what I'm saying? Are you picking up what we're putting down? We need to understand interest cost versus interest rate. This is valuable information. So, what else can we talk about? Paying off the credit cards in this way. Now, what will our program do? Our program will let you know when to put extra money on the credit card and when to put extra money on the mortgage to save you interest overall. We're still going to pay off the credit cards early. We're still going to pay the mortgage off early. The credit cards are still going to get paid off before the mortgage, but we're not doing it exclusively and ignoring the mortgage completely. Does this make sense to you? There is a time and a place and a way to do this to save you money. Folks, think about this. The more money you save in interest, the faster you get out of debt. Not how fast you can pay off a debt. It's how cheaply you can pay off a debt that matters because of the interest cost, not the interest rate. Interest cost versus interest rate every day of the week. Being with the P.I.L.L method is not just the technology. Just the coaching alone is worth the price of admission. Just the coaching alone, just the strategy sessions that we have with each and every one of our clients. Each and every one of our clients gets strategy sessions, so they will not. Some of our clients, if they don't have those strategy sessions, they will put their old ideas into this new program and they will not get the results that they're looking for. Not at all. So this is why we offer that as part and parcel of this new program is the education so that we can undo the miseducation on how we view lending and our loans. Oh my goodness. That is what we're talking about today. Listen, what are we talking about next? I got a whole list of stuff here. All right. Simple interest versus compound interest. Anybody ever heard of that? Simple interest versus compound interest in trying to explain how lending works. Okay, Liza, you're in the room. Oh man, I'm in the back channel. I just saw you come in. All right, there she is. Liza, how are you? Liza, I like that PTR, okay, that you got there. That looks good. That's a new picture, all right? So I'm glad to know that that's you, because when I see the picture now, I don't know what to say. All right, folks. So what are we talking about next? Simple interest versus compound interest. I got to make it my note here. Simple versus compound. Have you ever heard that? Have you ever heard that? Listen, we got 10 shares in this room. Listen, we need to share this room. Listen, if you have gotten value out of this room so far, if you've heard some things you've never heard before and nobody else is teaching, all because, you know, I'm autistic and I see things here that no one else sees, and I'm teaching it to you. If you're finding value that you're not going to get anywhere else, I need to get more shares on Clubhouse. Okay? Go ahead and share it, folks. Share it on Clubhouse right now. I need to get up to at least 20 shares because you guys are getting valuable information that other people roaming the hallways looking to see what they can find on Clubhouse so they can stay out of the drama rooms and come in here that's going to help them save money. All right? I mean, tons of it by not doing what they've been taught to do for years. How many have heard you need to pay off your credit cards every single month. And now you know that you need to do it strategically so that you don't pay a lot more interest somewhere else. Oh my goodness. That's what we're up to 13. Come on, share it some more. Share it some more. I see somebody even clipped what I said already. That's a good clip. I hope it was a good clip that you received. Let's talk about compound interest versus simple interest. So, when you see somebody on the internet talking about leveraging credit cards or leveraging a line of credit to help you to pay off your mortgage, or putting your home in a HELOC versus a regular mortgage, and some people might express it as, if you put it in if you're using a HELOC, that's simple interest, but if you have a regular mortgage, that's compound interest. Okay? Not true. Not true at all. Mortgages do not use compound interest. Compound interest means that when you get interest on your earnings, let's say you have an investment, all right, or you have an insurance policy that pays you dividends. So when you receive those interest payments, they become part of your principal. And now the company that's paying you interest now starting to pay you interest on your interest. That's the compounding effect of compound interest. Getting interest payments on your interest. Mortgages don't work that way. That you pay interest on the unpaid balance for 360 months. That's an amortized interest loan. So it's amortized interest. Okay? Now, here is what we're talking about. I don't care what kind of loan that you have, whether it's a credit card, whether it's a home equity line of credit, or conventional mortgage or FHA mortgage. They're all amortized interest, all of them. Some of them have different rules. Okay? So, how a mortgage works. When you get your mortgage, okay? When you get your mortgage, how does that work? How are we looking at that? Okay? When you get your mortgage, here's what's happening. You are paying interest on the unpaid balance. And while you're bringing down the principal bit by bit, you're paying interest on the unpaid balance. That's why it's so expensive. All right? So that's amortized interest. It's not compounding interest. But you're charged the interest on a mortgage monthly. You only pay daily interest 2 times during a mortgage. Once before the first payment, and when you call to find out what is my payoff. I want to pay off the entire rest of my balance. Then they will give you a payoff that is good until a certain date. And they figure daily interest there. That's the only time your mortgage figures daily interest. 2 times, at the beginning and at the end. Now, even though the other loans that I mentioned are amortized and not compounded, what they do is, on a line of credit, you pay interest on the average daily balance, but it's still based on an amortization schedule. But they do start charging daily interest, and then they average out the daily interest so that you will pay interest charges based on the average daily balance. That's the difference between your credit card, your line of credit, and your mortgage. They're both amortized. It is not simple interest versus compounded interest, because compounding doesn't exist when it comes to mortgages and other loans in the first place. So let's get rid of that. So has that myth been sufficiently busted here today? Okay? If it has been, put a number 9 in the chat and share this out a few more times. And if you're online watching this, go ahead and share it to your family and friends on whatever platform you're watching us on. All right. All right. So what else can we talk about? It's 8:15 a.m. Let's do a quick reset. You are in the P.I.L.L method room right now. What we're talking about is part 2 of how to choose the best mortgage terms, how to set up your mortgage so that it saves you money and so you're not giving all your money away to the bank. And if you're not a member of this club, go ahead, click that green mansion at the top and follow me and follow the club. If you're getting good value here, go ahead and follow me and follow the club. That is the only payment we're asking for. That's called social currency. All right. I am not pinning a link to the top for my Cash App. Okay. We ain't doing that. I know some people do, but we're not doing that. So what we want to make sure is if you're getting value, then whatever the Lord puts on your heart, then that's what you're going to do. I would much rather have you as a long-term client helping you and your family. What if you knew this when you just started out on your own? What if you knew the stuff we're talking about today? Folks, here's what I'm talking about. If you knew this stuff, you'd be much further ahead because you're not in the financial position you're in. You're not in the financial position you're in because you've been irresponsible with your money. Most of us are in the financial position we're in is because we followed the advice of so-called experts for years. And we didn't know how it was hurting us. And I'm here to tell you, it's not your fault. It's not. How could it be? It wasn't because you weren't paying attention in class. It was because there was no class. There's no class on this. It's only here. Why? Not because how smart I am, but because how my brain is wired when I see things other people don't. That is a total gift. I can't even take credit for that. For some reason, God chose to wire my brain this way so that when I look at an amortization schedule, I just see things differently. And now I'm sharing it with you. How about that? So if you want to know more about what we do, you want to know how we do this. If you want to know more about it, then get a savings and earnings report today. Go to my website, PILLmethod.com. I'm going to put my link up to the top here so that you can see what my link is. Let's see, cancel that. All right. So we're going to put in, put our link up and let's see, ICE10K.com. There you go. So you can go to ICE10K.com and find the link that says get a savings and earnings report, or you can go straight to our website, which is PILLmethod.com, and start learning this information for yourself. And most importantly, if you have kids, if you have grandkids, if you have nieces and nephews, if you have young people in your life at all, you can start teaching this to them. Now, why am I putting all of this content on YouTube? It just occurred to me. We've been here for over a year. Okay. And this is show number, I can't even see what show it is. 167, 168. I don't know. 160. I don't even know. You see, tomorrow is not promised to any one of us. Tomorrow is not promised to any one of us. If something should happen to me, these videos are up forever. The book is out there forever. These videos, people watch them over and over and over again, and they can be shared. So, folks, if something should happen to me, we want the information to go out. I don't want it to die with me. I've been given a mandate. I've given you a gift. Go out and give it freely. You have received, the Bible says, freely give. So we're giving it out. All right. So, but in the meantime, guess what? I read another book that talked about the go-giver. All right. And in that book, it says, your income will be determined by how many people you serve and how well you serve them. If you serve people well. David says this is episode 171. Thank you, David. All right. If you serve people well, they will pay you for what you know, for the value you provide. Lady Miz knows that to be true. Lady Miz says, I'm providing value. She says, listen, I've even got my own chip company. She's got her own snack food company. People pay her for the value she provides. Some of you have businesses in here. People pay you for the value you provide. Here's what I'm saying. Provide more value than you ever take in money. People appreciate it and will tell others. They'll be your biggest cheerleaders. So, folks, go and get your savings and earnings report right now. Fill out the information. Follow all of the instructions. And someone from my office will get with you within 48 hours of you submitting your financial data. And here's what you're going to know. The month, day, and year you're going to be debt-free. How much interest you can save. And then we're going to show you that interest savings, how much money you could possibly earn for you and your family by not giving it to the bank and taking advantage of compound interest. Compound interest. So, folks, that's what we're talking about today. All right. Do I have any questions or comments before I go on? Let's see if I can find. Can we find? I got my list here. Can I find another thing to talk about? All right. Let's see. Interest rate quote. We went over that. Oh, biweekly payments. Oh, has anybody used or heard of biweekly payments? Biweekly payments on the mortgage to save money. Have you heard of biweekly payments? Put a number 1 in the chat. Put a number 1 in the chat right now if you've heard of biweekly payments. And we're going to tell you the truth about biweekly payments right now. All right. In fact, let me see if I can, sometimes I get an impression to do something. But I'm going to search in Google biweekly payments right in front of you. Biweekly payments, WEEKLY, biweekly payments. And let's try to find out by searching what is the benefit of having a biweekly payment. What is the most you can save on a biweekly payment on a 30-year mortgage? I'm seeing if I can see it just right offhand. Okay, biweekly payments in a year. How do biweekly payments work? Biweekly payments. Okay, benefits. Okay, let me see what we can see. Benefits. Let me add to that. FITS. Let me see if we can find out what the benefits are. Okay, biweekly payment benefits. Monthly Chase Bank. Let me see what Chase Bank has to say about it. Biweekly payments. And what is the most we can save? I'm going to see here on a 30-year mortgage. Let's see. What is the biweekly benefit? I'm not seeing it. Let me just go ahead and tell you. All right. If you do the research on it, if you call your own bank, all right. All right. And Charmaine says Break it down. She's all ears, okay? You're going to be able to save anywhere between 4.9 and 7 years on a biweekly payment, okay? Between 4.9 years and 7 years. The most you can get out of a biweekly payment is saving 7 years. That means you turn a 30-year mortgage into 23 years. Okay, let me show you something here. When you have a mortgage, with us, and you want to learn the interest cancellation techniques, you can pay off your mortgage in 7 and save 23. Most people who have a biweekly payment with us end it. They don't do a biweekly payment anymore once they become our client. They turn it off. Here's what's happening. So I need your participation to make this work, though, folks. When you have a biweekly payment, you're paying like on the 1st and on the 15th. You're paying every 2 weeks. All right, about the 1st and the 15th. So if you're making a biweekly payment, when you make that first payment in the month, how many people believe you are saving time and you're saving interest when you make that first half payment? How many people believe? So if you believe that you're saving money, put a yes in the chat. Put a yes in the chat if you believe by making 2 payments a month, when you make that first payment, you're saving money. And when you make that second payment, you're saving money. How many? Go ahead and put in the chat if you believe you're saving money when you do that. All right. Put a yes in the chat if you think you're saving money. All right. All right. While you're answering that, all right, Armin says here, he's running large balances on credit cards, will reduce credit ratings. Does the calculator take that into account? So, Armin, why do people want a good credit rating? Why do they want a good credit rating? That's number one. Tell me why they need a good credit rating. Remember, we're busting myths here. And David Hunt says, yes, he believes that you're saving money every time you do that. Here's the real answer. Mortgages, write this down. Mortgages only accept full payments. Only. When you pay once on the 1st and the other one about the 15th, it doesn't save you a dime. Not 1 penny. It doesn't work that way. Okay? There are 2 months out of the year where you're going to pay 3 of those half payments because of the extra week. Every 6 months, you're going to pay once about the 1st, another one about the 15th, and the other one about the 30th of the month. All right? And so that makes 3 payments. So that extra half payment in that same month, that's the one that saves you money because that payment goes straight to principal. The 3rd payment in the month goes to principal, and you only do that every 6 months. So in other words, every 6 months you pay a half payment, which means your 12 payments becomes 13 payments a year. That's how a biweekly payment works. All right? That's how it works. So did you get the Charmaine, does that make sense to you? Charmaine, that's how it works. And so if you have money available, what if you have a couple of dollars in the bank? All right. But you're waiting every 6 months to pay to put extra money on the loan. Let me show you what happens here. Let me show you what happens when we look at it that way. Let's go back to our mortgage. We have our $200,000 mortgage at 6%. Let me pull this up. We're going to make that bigger. Let me show you what happens. Do you see right now, if you're new to the room, go to YouTube and search P.I.L.L method and also subscribe, comment, and like the videos on YouTube. All right. Here's what we're looking at here, folks. Look at your interest payments. Okay. They're the most expensive they're ever going to be right now. If you only ever attack your mortgage every 6 months. So for in 6 months, you're paying big interest payments. 1, 2, 3, 4, 5, 6. Okay? 6 months, you pay the biggest interest payment. And then when you pay that extra payment, you attack this one. You attack the 7th payment. But then you do it for 6 more months. 1, 2, 3, 4, 5, 6. Every 6 months, you're paying a lot of interest that you could be avoiding. All right. Charmaine says, I can't come up to the stage. All right. But would appreciate any extended understanding of biweekly mortgages. I currently have one and have never understood the benefits or the cons. My mortgage is adjustable. All right. I love adjustable mortgages. Okay. You just need to know what to do. We went over that. We went over adjustable mortgages in Monday's, Wednesday's show. And folks, did you know that on YouTube, you can click on something that you can actually see the written transcript of what we're talking about. So you can just scroll down until you see that we're talking about biweekly mortgages or whatever. You can see what we're talking about and then start playing it from there. Just so you don't have to watch the whole video if it's not talking about what your particular subject matter needs. You need to talk about at that time. Just scroll down through the transcript, find what you want, and play it from there. All right, that's a little tip for you. All right. So what are we going to talk about? So we've talked about that, and folks, we're in our last half hour. We're in our last half hour of what we're talking about today. In our last half hour, and I want you to know that. Let's see what else we went over that. I hope you. Kids, does anybody have any other questions about biweekly payments? All right, let's talk about escrow accounts. All right, escrow accounts. What does that mean? If you can, an escrow account is when you make your mortgage payment and your taxes and insurance are added to the payment. All right, so what we have here is just the principal and interest payment. So, and on average, now this is just an average. It doesn't work out this way all the time. But if we have a payment of $11.99.10, so you're going to pay somewhere between 20 and 25% of that is going to be your escrow account. So we're going to add plus 20%. Equals, that's $239. So it says on average, your taxes and insurance would come up to about $239 a month. We add that to the payment. So your total payment is $1,438.92 if you add that money to your mortgage account. And your bank or your bank or mortgage company says, listen, we're going to do that for you as a favor. We're not even going to charge you for that. Okay? But guess what? All they're doing is taking your money and putting it in a savings account so they can pay your taxes and insurance. And you don't get a dime of interest off that money. Guess who's making money off of all the escrow accounts out there? Oh my goodness. Lady Miss says she found that out, and she heard what we were talking about not too long ago, called up her bank and says, can I stop paying escrow here and pay my taxes and insurance on my own? They said, sure you can. Lady Miss, can you talk about that? I don't know what she's doing. She may be busy. She said this, listen, she was surprised to find out you do not have to, on some mortgages you do, on some others you don't.
Hey, yes. Can you hear me?
Yeah, I can, most certainly can, Lady Miss. What you talking about?
I'm in the car. I'm in the car driving to work. But yes, absolutely. I did not know until I heard you talking about it that you don't have to pay your homeowner's insurance and your escrow included in your mortgage, and you could pay that on your own. Of course, anybody doing this, you got to be a person that is responsible. It's not about, hey, I'm eliminating a bill and I don't get to pay it. You still got to pay it. You don't want to lose your house. But I definitely was able to do that, and my mortgage payments dropped like almost half
What?
of what. I could not freaking believe it. Now, of course, now I get to determine how I want to put away for my insurance. I could pay the insurance in full if I want and just be done with it for the year. Like I like the fact that I get to control how it is, and I get to keep the money and gain the interest while it's sitting in the bank until I pay, and they don't get that. So that's like a blessing, amazing to me.
Wow, wow, wow. Thank you, Lady Misses. Listen, folks, people are picking up all kinds of gems in here. Go ahead. We're at 13 shares. Let's get it to at least 20 shares. And just to be fair, get the information out there. You're getting good information here, folks. And you need to give it out to the folks. So your escrow account, let me tell you what's going on, Lady Miss, that I didn't share with you before. The main reason why banks want you to set up an escrow account is not to do you a favor. And the main reason is not even the interest they earn from it, because multiplied by all of their customers, the amount of interest they can earn is tremendous on your escrow account. But that's not the main reason. Would you like to know the main reason why banks love escrow accounts, Lady Miss? If you're saying something, I can't hear you. But anyway.
Yes, I can. Yeah, I mean, yes. Because I mute it because it gets a little noisy. I don't want to be,
I
going crazy.
understand. I understand.
But yes, absolutely.
Okay, folks, I need you to look up fractional reserve lending and learn about it. Fractional reserve. Let me see if I can pull this up. FRACTIONAL. Fractional reserve banking. Fractional reserve banking or lending. Find out what that's all about. Okay, it's in here. Somebody did a master class on it. All right, fractional reserve banking, how it works. All right, so here's what here's what we're talking about. For every dollar a bank has on deposit, they can lend out between $7 and $10 for every dollar they have on deposit. Did you know that? What does that mean? If I'm a bank, if I have $1, the government says it's legal for me to lend out $10 based on that $1. So if you have a bank account, with $10,000 in it, hey, you have a bank account with $10,000 in it, the bank can literally, let's multiply that by 10, can literally lend out $100,000 based on that $10, that $10,000. Lady Miz, did you know that to be true?
Yeah, well, not in the sense of how you put it, but I always knew, not always, but I knew that the bank was lending money that they really didn't have.
Yes.
Um, so that was my main thing, and also just the fact that it's it's sad to say, and I don't want to say nothing wrong, but here, especially in this country, where when you pay stuff off, you can still lose your home if you don't pay your tax, if you don't pay water bills. It's so much that go into that, and be careful with how we do things, because even when you have it, pay off everything, and you don't, you might think that you paid off your mortgage, but you still have those other responsibilities, and you could end up losing your home in the bank, or they could take it back and then resell it again. So they're always winning. They are always winning. But I'm glad your program teaches us how we can win.
All right, folks, here's another thing that we're going to talk about. So we talked about escrow account, and in that escrow, could be in there. You could have PMI, okay? Private mortgage insurance. Let me tell you about private mortgage insurance. Did you realize that by taking out that insurance, why do we have private mortgage insurance? What does anybody know what private mortgage insurance is all about? Who does private mortgage insurance protect? Who's it protect?
The bank.
The bank. So if you don't pay, when you pay, because you're now paying that insurance, who does that protect? It protects them. So can they still get paid on the house if you default?
Yes.
Oh my goodness. Oh my goodness. So why do they need to take possession of the house so they can sell it again? Aren't they getting paid twice?
That was my point that I was making. There you go. That's exactly what I was trying to say.
Oh my goodness.
They get paid twice.
This thing looks better and better. You know, in my younger days, I said, this looks gooder and gooder for the banks. But folks, all I'm saying is, why can't we just be better educated and be educated consumers when we go to the bank and learn how to borrow money at a discount? I love borrowing money at a discount. It is amazing to me what we can do when we know how. When we know how, we can save so much money. So listen, some of you right now are paying PMI and you don't have to. On some types of mortgages, so you're going to have to call your mortgage company and find out which type you have. On some, they require you to have PMI forever. Okay? On some, you can end your PMI payments once you have paid down your loan by 20%. Okay? So now instead of 100%, okay, and instead of owing all that, so they'll look at what your equity is, all right, and they're going to do a calculation, and if your mortgage is paid down to the point where your loan to value is at 80% or less, then you don't have to pay PMI. But the bank, even though they know you are paid less, okay, you're paid down to that point, they're not going to call you and tell you you're not required to pay PMI anymore. They won't tell you. So if you've had it for the length of time that you're supposed to have it, and when the math is done, all right, the amount of money that you owe versus the amount of money that your house is worth, if you're 80% or under, you may be able to stop your PMI payments. You just have to apply. Those are the things we're talking about that saves you money. Now, what if you could take that money and apply it to principal? Not only that, but what if you had like Lady Miz, you're putting your extra money into an account all for yourself, okay? And what if there was a way you could take some of that money that you're leveraging over the months that you have, because you're going to keep it in there for 12 months. But what if you could every now and then, if you carefully do it, take out between 200, let's put the amortization schedule back on the screen, take out between $200 and let's say $600 out of that, okay? $200 to $600, okay? Do you know that money that's sitting in your bank account that you're leveraging could actually save you almost $3,000 on this mortgage by using that money strategically? And our program is designed to help you to, if you are putting your escrow money into an account, we can show you how to leverage that money that you're putting into that account to save you big time interest on your mortgage and still pay your taxes and insurance on time. We'll build it right in to the program. Oh, there is just so much to learn here. All right, let me see. What else do we have here? All right, simple interest, we went over that. Okay, consolidating the loan, refining, we went over that. Listen, folks, I think we just about covered everything that we wanted to cover in these first two shows. Let's talk a little bit about what we're going to be talking about on Sunday. We're coming up on tax season. We're coming up on tax season right now, folks. And there are a lot of articles out there, all right? They're on Clubhouse. They're doing shows. They're doing rooms on tax loopholes. Tax loopholes. Let me tell you something. With all the tax loopholes that are out there, most of us will pay more in interest than we'll ever pay in taxes. Why aren't there more loopholes when it comes to paying mortgage interest? I'm going to go over the biggest loophole ever that is not contained in the tax code. We're going to talk about how to make 100%, 200%, 300%, 400% on your money, and you never have to pay taxes on it. We're going to go over that on Sunday. So you want to be here on Sunday, folks. You want to be here when we go over that. And we start the show at 8:30 a.m. Central Time. That's 9:30 a.m. Eastern Time. If you can't be with us, catch the replay. But we're going to be going over the biggest tax loophole ever that's not contained in the tax code. This is the biggest loophole ever. I'm going to show you how you can use the loans that you have to take advantage of this loophole and take your debt and learn how to turn it into wealth. Armand, he's got a question here. It says, running large balances on credit cards will reduce credit ratings. Does that calculator take this into account? And so what I was asking before, Armand, yes, it does take it into account. But the thing is, why do you need a good credit rating? Most people want a good credit rating because it gives them the opportunity to get a lower interest rate. And did you know, the lower the interest rate, did we talk about that? Did I leave that out? I left that off the list. The lower the interest rate, folks, the harder it is to pay the loan off faster and cheaper. Okay, he says to qualify for more credit. Now, here's what you need, Armand. You need to know this for a fact. When you see Credit Goddess in here, you need to tap in with her. She knows people have 800 credit scores that get turned out for credit every day because their credit profile is out of whack. You need a good credit profile. There are people out there, my engineer Kurt has put her information there on the screen. creditgoddess10k.com. Contact her, creditgoddess10k.com, and she'll talk to you about credit rating and credit profile. And she can show you how somebody with a great credit profile and a 650 credit score can get more credit than you with a poor credit profile and you have an 850 credit score. Oh, yeah, it is possible. So you need to know why we do what we do to make sure you're in a position to make sure that when you want to borrow money, you can. And it has to do more with credit profile than it does with credit score. If you are in business, then you want business credit, not personal credit in the first place, because when it comes to business credit, your utilization doesn't matter. Personal credit, you want to keep your utilization between 1 and 7%. You want to keep your utilization between 1 and 7% on if you are using your personal credit. If you have business credit, you can use 100% all the time. Ha! And it doesn't count against you. Okay? You just pay it back when you pay it off. Then you can run it up to 100%, but it doesn't count against you. It does not. And you can pay it off. All right? If you're in business. So it's not, you want to know what the rules are to credit, folks, if you want to be in a position to help yourself. Okay? Yolanda Sells Michigan says she had to hop over here on Facebook. Hey, this is powerful stuff you're dropping. Sunday, here we go. So we're going to be right back here on Sunday, folks, to give more information out to you then. So I wanted to give this last example, give you last example of how a higher interest rate can actually help you more than the lower interest rate. And before, we showed a $200,000 mortgage at 6%. And then we showed earlier how you could have a $200,000 mortgage at 3%. Let's show this last example, and we're done for the day. So we're going to duplicate this tab. We're going to put in the same mortgage at 3%. Take that out. Okay. Now, here's what we have. I got the choice between a 6% mortgage and a 3% mortgage. The 3% mortgage, the payment is $843.21. The 6% mortgage, the payment is $1199.10. And you know that, remember, when you control the principal payment, you control the loan. Watch this. My principal payments are in the $200 range. And you've already learned that if we prepay the $200.10 on line 2, it saves us the interest on that line, and we eliminate line 2 from the mortgage. But if I lower my interest rate to 3% and get this lower payment, look at my principal payment now. My principal payment is now $300. I need to come up with $344.07 to get rid of one payment off my loan at 3%. I only need $200 at 6%. Be careful how you do that. Work with an expert to find out the right interest rate for you, not necessarily the lowest interest rate. That's why we're here, folks. Just the information, just the training, just the financial education you're going to get from P.I.L.L method is worth the price of admission, and it keeps you from making huge mistakes by lowering your interest rate, thinking you're putting yourself in a better position where in fact you could be putting yourself in a worse financial position, and the bank is going to make you pay for it. You got to pay closing costs for this. Go back to a 30-year loan, and it's going to make it harder for you to pay the loan off faster because now you have a higher principal payment. Folks, I want to thank you for being here today. I hope you had a good time. If you had a good time, put a number 9 in the chat. Put a number 9 in the chat if you like this information. I need you to come back here on Sunday to get more information. And if you loved it, if you love the room, then go ahead and find out how this can work for you, how the P.I.L.L method can work for you for a lifetime. And we're going to show you how to use the bank's money and the interest you don't pay them to pay for your lifetime program. Let's get the bank to pay for your program. I love that. Okay, so you want to go to, here are the 9s. The 9s are coming in. The 9s are coming in. Steve Mack says, thank you very much. So folks, listen, go to my link, ICE10K.com, ICE10K.com, and get your savings and earnings report today. Get it today. And if you want to go straight to our website, you can go to PILLmethod.com and do it there as well. follow all of the directions. Get to the financial page, put in all of your loans, everything. Don't leave anything out. All right. Put all your loans in, and then tell us a little bit about your income and how much money is left over after you pay your bills. We'll tell you the month, day, and year you can be debt free and how much interest you can save. Take that interest saved that you didn't give to the bank and turn it into wealth for you and your family. All right. So, and don't forget to get the book. Get the book today as well. Go on Amazon. It's the only book of its kind on Amazon right now that talks about what we're talking about here. Get the book from Amazon. And then once you get the book, what can you do? You can do this. Learn from it and then share it with people in your family, especially young people, before they get out on their own and and before they can learn it wrong, teach it to them the right way. All right, folks, we're going to be out of here. We're going to hear from, on behalf of myself and Kirk Nugent, who runs everything here for us online. We're going to say goodbye. We're going to see you again on Sunday, but we want to hear from Dr. Eric Thomas one more time. See you on Sunday, everyone. Thank you for being here today. My name is Don Daniel, founder of P.I.L.L Method International.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.